Today I'm going to talk to you about bonds, by which I mean government bonds, gilt-edged securities, or government stocks they're known as in the UK, or what's known as corporate bonds. Corporate bonds being debt borrowed by companies, because companies, public companies, this is PLCs, the large companies that quote on the stock market, they can raise money either by issuing more shares or by taking on more debt, and typically they'll issue what are called bonds, corporate bonds. Whereas the government, every year the government spends more than it receives in tax receipts, and to make up that difference they issue government stocks, gilt-edged securities, in other words group together their government bonds. I've only known 1 year, I think, in my entire adult life when there wasn't a public sector borrowing requirement under Margaret Thatcher's reign. There was 1 year where the tax receipts exceeded expenditure. So this is a perennial problem for governments, particularly the UK government. So these stocks, these corporate bonds or government stocks, have always been considered to be low risk investments, because although their value can fluctuate up and down, generally speaking, the fluctuations in value are lower than they are for shares, for example. Shares can be more volatile, price can fluctuate more. So shares are considered a higher risk investment than bonds. However, that doesn't always hold true. And for example, where we sit here today, and I'm making this video in May 2021, the UK interest rate today, the base rate, is 0.1%. That's the record lowest level of interest rates in the UK in the history of the Bank of England. Record low. And that's been since March 2020. Now, I recall when base rates reached a record high in November 1979 of 17%. Hard to believe, but that's absolutely the truth. And what's happened since then, we've had a 40-year period in history when base rates have gradually declined, they've gone down. And what's happened during that time is that the value of bonds has risen, because bonds, corporate bonds and government stocks, have what's called an inverse relationship to interest rates. So when interest rates fall, it's like a seesaw. So when interest rates fall from 17% to 0.1%, the value of bonds rises. So it goes in the opposite direction. That's the value of bonds. And that's the interest rates, 0.1%. In fact, it's better depicted by like a seesaw, really, a seesaw effect, because that's what it really virtually is. So you have a seesaw, interest rates, the value of bonds goes up as interest rates go down. So we've had that now for 40 years. So bonds during that time have been quite a safe investment. They've tended to rise in value most years. They can form part of an overall diversification of risk portfolio. You might have some money in bonds, some money in cash, some in commercial property and some in shares, probably primarily in shares in most cases, but nonetheless you'd have these different asset classes, what are called the four main asset classes, including bonds. That's all very well, but what happens when interest rates go up? Well, we've got this seesaw effect. You see the seesaw going down. Well, the complete opposite is going to happen when interest rates rise. The value of bonds will fall, so it will have the opposite effect. And the bonds will be bottom of the seesaw and interest rates will be at the top. So what does that mean for the prospects for bonds? Well, I consider bonds doomed. I feel that strongly about it. Interest rates have only got one way to go. They are going to go up. It's inevitable. And also because inflation will rise. All the commentators around the world agree that inflation will rise. The US has already announced that they're going to let inflation rise. And what happens to control inflation when it gets out of hand? Interest rates always rise. So this is an inevitable stage of this long-term economic cycle we're going through. So interest rates are going to rise, bonds will fall. So what does that mean to you? Well, let me give you an example. In Germany, they announced recently that if they were to increase the German base rate to just 2.5%, that would mean the value of German bonds would fall by 25%. 25%, I kid you not. Now, a fall of 25% for an asset which is considered low risk doesn't make it low risk in my mind. Any asset that can fall in value by 25% is not a low risk asset anymore. It doesn't mean that bonds haven't historically been a low risk asset. If you judge them by the volatility, the amount by which they fluctuate in value, historically you can argue they have been lower risk. But some commentators have estimated the value of bonds could fall as much as 70%. Now, whether it's 25% or 70%, I don't really care. What I do know is you can't class bonds any longer as a low risk investment. Bonds are now a high risk investment, in my opinion, and they play no part in your portfolio. So I would heavily recommend that you come out of bonds completely. The great Ray Dalio, one of the greatest investors in history, and the man who runs the largest hedge fund in the world with $160 billion of assets, recently said that it would be madness to invest in bonds. I don't know about you, but I think a great investor guru, one of the greatest genius investors in history, when he tells you it's madness to invest in bonds, I would always agree. And let's face it, the logic, the theory is completely there for every qualified financial advisor knows this. So if you're invested with a financial advisor who's still got your money in bonds and hasn't brought up the subject, you really need to address it now, because we're advising all of our clients to not invest in bonds. You know it's the right thing to do. Bonds are doomed. You heard it here first.